Hello everyone, this is Chapter 14, Long-Term Liabilities, produced by, and the cinematic director was Dr. Edson. So let's start Chapter 14. Chapter 14 is actually a little bit tough. So we've had a couple of easy chapters, now we're going to get into one that's not quite so easy. So the things that we're going to talk about in this chapter are bonds. We actually talked about those in the present value chapter. So if you didn't like them then, you get a second chance to see if they're your thing. So we're going to talk about bonds payable, issuing, we've done that. Types, we haven't done those things, although the types, this is usually the hard part. Long-term notes payable, which is frankly just exactly the same as bonds, and then some other types of liabilities. So the real thing we're going to talk about is bonds. Pause that. Okay, this chapter talks about all of these examples, and basically last chapter we talked about current liabilities. This chapter we're talking about long-term liabilities, and these are some examples. Most of these, since they're long-term, they're going to involve present value computations. Long-term debt also has some covenants. So a covenant is something you have to do in order to keep the bond outstanding, so nobody will call in the bond per se. So let's say you might have to have your current ratio at a certain amount. You might have to have your debt ratio at a certain amount. So for instance, to borrow more money, you can't go higher than 40% debt. So you can have various covenants. Restrictions are just basically things you can't do. Restrictions and covenants can be pretty similar. Okay, just some terminology. A bond indenture is part of issuing the bond, but basically let me explain a bond like this. So you know that stock sells for, let's pretend it's $100 a share. So if you want one share of stock and maybe there's 100,000 outstanding in the company, you can buy one share of stock for $100. Or you can buy 100 shares of stock, and if they're $100 each, then I'm going to have $10,000 worth of stock. So I just can buy additional shares of stock for greater investment in the firm. So a bond takes that. Similar to stock. So I could go to the bank and I could borrow $100,000. But what if I need $1 million? Or what if I need $5 million? So it might be kind of difficult to find one bank to loan me $5 million. So what I do is, like stock, I divide them up into increments. In most bonds, it's $1,000 increments. So if you want to loan the company $1,000, you in essence buy a bond for $1,000. So the difference between stock and bonds is bonds, they have to pay you that $1,000 back, and they will pay you interest, and that interest will be stated on the face of the bond. As with stock, they don't ever have to pay you the stock back. They don't have to pay you a dividend, but your expectation is that the stock price will go up or they will pay a dividend, so that's how you're going to get your money out of stock. It's not guaranteed, but certainly if you bought Apple stock or you bought Facebook stock a while ago, certainly your initial investment would have gone up. Whereas notice, you're only going to get the $1,000 back for a bond and whatever interest rate, let's say it's 6%. You're only going to get $60 of the $60 interest and the $1,000 back for every $1,000 bond. Whereas stock, you could get much more than that. Usually interests are paid semi-annually. That's kind of important for you to remember. Here's some types of bonds. Secured bonds. Secured bonds have security backed for them. So basically it's a little bit like if you go to the bank and borrow money on your car and they take the title. So secured means the bondholders, if you don't pay, can come and get a specific type of collateral for them. Unsecured bonds, we say unsecured bonds, you get them because of the full faith and credit of the organization. So if you had a strong organization that has paid back bonds all their existence, maybe you don't require any collateral simply because they've always paid them back and they're a strong company. The next type are term, serial, and callable bonds. Really it's just, I guess all these three are kind of related. Term means a 10-year bond that matures at the end of 10 years. Serial bond means a 10-year bond that matures each year for the next 10 years. So a $100,000 term bond that's 10 years, all $100,000 would be due back at the end of 10 years. A 10-year serial $100,000 bond would be due $10,000 each year for the next 10 years. And a callable bond is one that the corporation can call in. So for instance, they can say, we're going to pay it back now. So a reason that they would want to issue a callable bond, usually if you issue a callable bond, you have to pay the bondholders a little bit higher rate of interest. But if you need the money now and the interest rate is high, you might issue a callable bond, which means you're going to have to even pay out a little bit higher rate of interest. But if the interest rate drops, so let's say you have to issue a 9% bond, and then you decide to issue it callable, and so the 9% is higher than the 8.5% you would have to issue if it was not callable. Okay, so let's say you issue it at 9% because you need the money now, but the interest rate is high, so you issue a callable bond and you pay a little bit of premium on that. And then in 2 years, the interest rate drops to 6%. So basically what you'd say is, I'm going to call in all my bonds, and you'd issue new bonds at 6%, and you'd take the proceeds of the new bonds and pay off your 9% bonds. Now, if they weren't callable, nobody's going to sell their 9% bond to get it to buy a 6% bond. You're just going to keep your 9% bonds. So that's why they have to issue callable bonds. Convertible bonds can be converted into usually stock at some point in the future. Commodity-backed bonds, you can elect usually to get the cash back or a commodity. So for instance, you can get paid back $1,000 at the end, or it may be stated you can get your $1,000 back, or you can get X number of barrels of oil. So if the X number of barrels of oil are worth more than the $1,000, you're going to want to take the X number of barrels of oil, or let's say gold or silver. So you can elect to take the commodity or the cash. Deep discount bonds, the deepest discount bond is a zero coupon bond, and we've talked about those. But you could, if the market rate of interest is 10%, you can also issue a 1% bond. But notice we'll talk about that later. But a zero coupon bond, as we've said before, if it's a $100,000 bond and it has zero interest on it, you actually sell it for much less than $100,000. We're going to get into that in just a second. Registered bonds are when your name is actually registered with the company. Bearer bonds or coupon bonds is whoever owns the bond and tears off the coupon gets the interest. So you, in essence, it's like perforated on the side. You tear it off and send it in. Okay, so look at that. I found a picture of a bearer bond. So notice these are little coupons, and most bonds are pretty ornate, just like a dollar bill is, so that you can't counterfeit it very easily. But notice that these are the coupons that you tear off. So you tear it off, and a lot of times on the back you would write your name and address on, and you'd send it back, and the company would mail you the interest check, so whoever has this. So a lot of times these coupon bonds are kept by a trustee in safekeeping, because you certainly wouldn't want to lose those. Okay, the last type are income and revenue bonds. Income bonds are would only pay interest if the company is profitable. And revenue bonds usually come from a specific revenue source. So a school district may issue revenue bonds, and the bonds are going to be paid back from a specific revenue source. So from proceeds from the state, or from collections on lunch money. Not a very good example. But anyway, they would be paid back with specific revenue. So the city of Quincy might have a revenue bond if they issued a revenue bond to improve their trash collection, and they would take the sticker fees and pay back the bonds. So those are those. Okay, just make sure you know all of those. All right, let's go back here. All right, so basically this is what a corporate bond listing looks like. Notice that you have in millions, so there's $3 billion worth of bonds, The price is 145, so you're probably selling at a premium. So both of these are selling at a premium, so it's a price as a percent of par, so 145% of par. The coupon is 6.5, so notice they're selling, that makes sense that they're selling at a premium because the coupon is paying a lot more than the yield. So the coupon stated rate, the stated what's on the face. So if this bond's paying 6.5 and the market is down around 3.5, these are going to sell at a premium because they're much better than the market. So I increase the price of the bond until the interest rate paid by the coupon equals the yield. And we'll talk through that in a second. All right. A lot of times when they print a bond, now sometimes you can choose whatever interest rate you pay, and the selling price of the bond just changes, which again, if you don't understand that, we're going to talk about it. But even if you did print the prevailing interest rate on a bond, it usually takes weeks or months until you actually sell it. So what's happened between that time is the interest rates change, so what you have to do is you have to adjust the sales price. So the same thing as if you go into a store and if you want something and you buy it, and let's say that the store is willing to negotiate with you, if somebody else wants it also, you may have to negotiate up and pay more for it. If no one wants it, they may put it on sale or discount it, and so you pay under market for it because they want to get rid of it. The selling price is usually set by simply supply and demand. So again, you go in the store, if nobody else wants it, they usually discount it. If everybody else wants it, we can set the price higher. The relative risk, you've studied this in economics, that the interest rate is made up of the risk factor, market conditions, state of the economy. So all of these have to do with the interest rate. So if you listen to the news, you'll see the prime rate went up, etc. And so then you would have a risk on top of that. So all that stuff you studied in economics is coming back again. All right, so just these are things that you need to know. The stated coupon or nominal rate, that's what's written on the bond itself. So if I brought that picture up again, I don't know if there's an interest rate on that bond, I just got a picture, but it would be written on the bond itself. So in the prior example, I believe one was 6.5%, and this one was 5.25%, okay? So that's how much it's paying. It's written on the face. That's the face interest rate, the coupon rate or the nominal rate. Make sure that you know all those terms mean the same thing. The market rate or the effective rate is the rate I sell it to make sure it earns. So let's say this is the face bond right here. We have a $10,000 bond that pays 10% interest. So it's going to pay $1,000. And let's say right after I issue it, the market rate, the market of the interest rates in the United States economy goes way down. The Fed reduces interest rates and the economy is great, et cetera, I guess bad or whatever. But they change the interest rate to 3. Notice this is stated on the face of the bond. So what I'm going to do is change the selling price of the bond so this is set because I know I'm going to get a $1,000 check. So I want what I pay for it to represent a 3% return, and that return is always going to be $1,000. So what I do then, if you notice, I just take this divided by that to get, I'm going to have to sell it for $33,333. Okay, so again, I change the face, what I'm selling it for, so that this $1,000 is the return I want to give. So let's see, notice if this is now, I'm selling at a premium because the 10% is way above the market rate of interest. But let's see what happens to it if I change it to a 13%. And so notice now I need this $1,000 to be a 13% return. So I change the face. So I'll show you 76.92 and 0.13. And so I see that 76.92 times 13% should be around $1,000. So now I've changed the face so that the interest it earns is actually now a 13% return. Again, if I change this to 10%, it should go right back to the face amount. So notice if the market rate of interest, so this is the face rate of interest, and the market rate of interest is here in, what do you call it, green. So if the market rate of interest is the same as the face, it sells for face. If the market rate of interest is below face, it sells for more because I want the $1,000 to be a 3% return instead of a 10% return. If it is above, then it sells at a discount because I need the $1,000 to be a 13% return. So if the $1,000 is a 13% return, I need to cheapen the bond itself. Now it gets more complicated than this because my little simple example works because I only have a 1-year bond and we're going to take it out into the future, and so we're going to assume it's going to earn 13% all the time in the future. Back here, the stated rate in my example would be the 10%. The market rate would be the one I keep changing it. So I'm forcing it to earn 3%, 12%, whatever. All right, so how do you calculate interest? We're going to do this over and over again, but what is actually paid is the $1,000 on my previous Excel spreadsheet. So it's the stated rate times the face. However, the actual interest expense is the market rate times the carrying value. And we've done that in the past and we're going to do it again. Okay, so this is kind of what I told you already. If the market rate is, if the stated rate is 8% and the market rate's 8%, they sell at par, which is the face. Par value, face value, same thing. If the stated rate is 8%, but the market rate is 6%, they're better than the market, so they're going to sell at a premium. So I need to change the bond face, and I don't really change the bond face. I've changed the bond selling price to make the returns equal 6% instead of 8%. However, if the market rate's 10%, these are going to sell at a discount. All right, so I'm going to find this first one. It looks like it's slide 17. Okay, so Buchanan Company issues at par. That means, you just learned it, if they're at par, it's going to sell for $800,000. So I don't really even need to go to my present value tables because I know at par means the interest rate, market, and face are the same thing. So dated January 1st, so don't forget to pay attention to that, and bearing an interest rate of 10%. At this point in time, all I really care about is that they sold at par and they're $800,000. So I'm going to debit cash and credit bonds payable for $800,000. Don't forget, bonds payable is always at face, and I'll keep saying that throughout this. Then down here, to record the interest payment on July 1st, so if you remember, the interest is principal times rate times time. So principal's $800,000 times 10% times 1/2 a year gives me $40,000. So I debit interest expense in cash on July 1st. And notice they pay interest on January 1st and July 1st. So on December 31st, the end of the year, I'm not paying interest until the next day. So my actual entry has to be to interest payable instead of cash. On January 1st, I'll debit interest payable and credit cash. But if they would have written paid on December 31st and July 1st and December 31st, this would be the same entry for both of them. Okay, so now record the same entries assuming the issue of the bonds at 97. So what 97 means is 97% at face. So somebody has gone through the present value tables like we did last semester in chapter 6, and we're going to use them again. And they have determined that it's selling at 97% of face, so it's a discount. Okay, then we're going to amortize the premium or discount using the straight line rate. Technically, you're supposed to use the effective rate, which means you use the carrying value times the market rate, which we'll do later on. But you can also use the straight line rate and say, all right, they're 10-year bonds. I'll have a discount I'll compute, and I'll just take that discount divided by the 10 years, which we'll do in just a second, okay? So 97, so I have 800,000 of bonds at 97. So look, bonds payable is always at face. Do not ever credit bonds payable for the 97%. Bonds payable is always at face. However, they get cash of 97% of face, and they plug the difference to the discount. Okay, now I said 10 years. Actually, it's 20 periods because they're paying semi-annually. So I take that $24,000 and I divide it by 20 periods, and so I have $1,200 of amortization of the discount. Okay, now think about this bond. It's an $800,000 10% bond. So $800,000 times 10% is going to be $80,000 of interest every year. So half that, because I have 6 months. So I have $40,000 of interest every 6 months. Most of the time, your journal entry for interest is debit interest expense, credit cash. However, I've got to do something with this discount, because this discount is really adjusting the bond to pay a different amount of interest. So let's go to the next one. So this one's this entry. Get it on the right one. There we go. Okay, so now look at your journal entry. So when we do this, we're going to do two different methods of amortizing the discount. We're going to do the straight line method, and then we're going to do one called the effective interest rate method. So under the straight line method and the effective interest method, your journal accounts are the same, but how we get these numbers is just a little bit different. So I would encourage you to debit interest expense, credit cash, and go back to here and see I credited the premium on this thing. I may have said discount before. I think I'm ahead. Hold on, I skipped forward. Okay. There, that's why I said discount, because it was a discount. So I have a discount on bonds payable, so notice this discount is debited. How did I get it? I know bonds payable is always face. I know cash is 97% of face, so I need a debit to balance, and a debit is a discount if I sell them for less. So that's a debit. So I'm going to get rid of that discount by crediting it. So if I made a T account of the discount right over here, see if I can actually do that. So bear with me in my drawing here. So if I made a T account of bonds payable, notice it has $800,000 in it, and I made a T account of discount, so it has a debit of $24,000 in it. If I net those two, so this is just like equipment and accumulated depreciation, you have to talk about both of them together. You cannot only talk about the bond or the discount, they go together. So where one goes, the other one goes. So they're just like a set of twins who are kind of attached there. They go together. So you have the carrying value of the bond is this minus the discount. So on the day it's issued, which is the only day it'll be this, it'll be that $776. Okay? All right. So now we're going to record the amortize the premium or discount using the straight line method. Okay. Let me pause this a second and make sure. So you're actually going to have 3 journal entries in here. Okay, so the first one was where I issued the discount or issued the bond itself, and now I'm going to record the interest. So always debit interest expense and credit cash. Okay, so I know my cash is going to be $40,000 because it's always face value times face rate. So I'd encourage you to, right behind there, put face value times face rate. Do it quicker than I'm doing it though. Okay, that is always cash, right? And the same thing here. Make your December 31st one and the cash, and in this case it would be cash, but I'm paying it on January 1st, and December 31st it's interest payable. So this is always face value times face rate. Then I want you to debit interest expense, but leave the amount blank right now. And then go back to the prior slide, and you see that you've got discount on bonds payable is debited. So I'm getting rid of it. So I credit discount on bonds payable for $1,200 and $1,200. So notice what is happening here is I have, I'm going to put $1,200 here, possibly if I can get it there. And I'm also going to have $1,200 again. So now if I drew a little T account and got a balance, maybe, this doesn't work very well, I would have 24,000 minus 2,400, so my discount is getting smaller. So as my discount gets smaller, my carrying value goes up. So this discount is 24,000 minus 1,200. Okay, so my discount is 2,400 minus 1,200 minus 1,200, or 21,600. and my new carrying value is 800,000 minus 21,600 is 778,400. So notice I'm going up, and notice this is getting smaller and smaller and smaller by 1,200. So in the end, my carrying value will be 800,000 because this will be wiped out to zero over 20 periods. So notice another way to think of it is my carrying value is going to move towards face by $1,200 every time. Okay, so that's kind of important to remember. All right, now we're going to record the same entry, assuming it's 103. So 103 is not a whole lot different, if I can get this to go. It doesn't like for me to. Okay, so now I credit bonds payable for 800,000 exactly like I did before, and then I debit cash for 800 times 103% or 1.03 to get 24. So now I need a credit to balance, and a credit is a premium. So notice that the premium goes the same way as bonds payable because it's increasing it. The discount went a debit. So now when I amortize that premium, 24,000 divided by 20, notice the word amortize. I'm amortizing the premium just like you amortize the life of an intangible asset. I divide it by 20 periods, and so that's $1,200, but notice the premium is credited, so now I have to debit it to get rid of it. So again, I'm going to go through the same way. I'm going to debit interest expense, and I'm going to credit cash and leave a space in between. Okay, I know credit cash is 40,000. In this case, it's interest payable is 40,000. And I know sometime I'll forget to check that date and then it's a day before and credit cash. But anyway, interest payable or cash, depending on whether they're paying it today or paying it later. I get rid of the premium. So the premium was a credit, so I debit it here. And I plug interest expense to be the difference. So I back into interest expense. So again, now I'm going to do those three entries right in there. Okay, pause it. The next one deals with, which this slide number is wrong because it's not 20, but the next one deals with what happens when you sell bonds between interest rates. Think about the coupon bonds where you tear them off. So if you sold it to somebody halfway between, let's say they pay on January 1st and June 1st, if you sold it halfway in between there, they're going to be the one tearing off the coupon and sending it in. So what you do is you usually add the interest that they're going to get that's actually yours to the selling price of the bond. So let's say the interest for the whole period, 6-month period, was $100. Okay, well, if you're going to get, and I own it for half the time and you own it for half the time, well, you're going to get all $100 because you're going to send in the coupon. So what I do is I add my $50 to the selling price of the bonds. So the buyers will pay the seller the interest accrued from the last interest date to the date of issuance, and then they'll receive all the interest. So in other words, the buyer pays for the interest they're going to get of the other person's. All right, so on March 1st, Taft Corporation issues, notice this is March 1st, 10-year bonds dated January 1st. So thus the original company, Taft, dated them January 1st, but they didn't actually sell them till March 1st. So whoever buys these bonds is going to get interest for January and February when they didn't actually own them, but they're going to get the check for it. So what happens is I add that to the purchase price. So they have a par value of 800,000. So again, bonds payable is always credited for a par value. The bonds have an annual interest rate of 6% and they pay semi-annually. So 800,000 times 6% times 2/12 for January and February, okay, is going to be added to that. So it's $8,000. So notice they credit interest expense. You could honestly credit interest payable, but because interest expense, crediting interest expense is going to be a little bit confusing. But notice I have a credit and interest expense. Let me see if I can draw this because it'll stay here. I really hate this drawing thing. Okay, so that's my interest expense, which has an opposite balance because you generally don't want an expense. So I'm only okay because year end doesn't happen in here. If year end happened between the time I actually pay it and this, I can't have a credit in interest expense. That's just wrong. Okay, so remember that. And then what happens when I pay for it, I debit interest expense, and there's calculate the bond proceeds. Oops, I'm right up here. Record the receipt of the interest. So that's up here. So I didn't really leave enough space for that, did I? So I debit interest expense and credit cash. So notice what happens is I have in here debiting it for $24,000. Let's do that. And so if I net that, what happens with the interest expense is I have $16,000 left in interest expense. And if you calculate it, think about it, go back, slide. This thing is not working very well. Okay, so interest, 800,000 times 6% times 4/12 is the amount of time you actually held it, is the $16,000. So by crediting interest expense, it nets out to the correct balance in the end. All right, next one. However, if TASH issued 6% bonds at 102 on March 1st, what is the entry going to be? So notice I have to, some people like to make this in two separate entries. Okay, so separate out the $8,000 out of this entry. Okay, and think of it, what I would do at 102, I would credit bonds payable for the face, always. Debit cash for 102. Okay, so I just put that in parentheses right there. 102 times $800,000 is $816,000. Credit premium for $16,000. And then I'm going to go ahead and do the interest expense that I credited and then add the other $8,000. So remember, I was $816,000 there. So add the $800,000, you get $824. So this cash is, put in parentheses there, the $800,000 times 102 equals $816,000 plus the $8,000 of interest that they're going to pay for. And then it works out just the same. Okay, the effective interest method is the next one. Let me pause this. Okay, the effective interest method, what we did was the straight line rate. Under the straight line rate, you simply take the discount, divide it by 12 or 20, however, how many interest periods, and you get rid of an equal amount. The effective interest rate is actually the more accurate. So notice the IFRS requires the use of the effective interest rate method. GAAP permits the use of the straight line method, if not materially different from the effective interest method. So you are really required, ought to use the effective interest method under both IFRS, International Financial Reporting Standards, and Generally Accepted Accounting Principles. So notice interest expense is carrying value times the effective interest, and the bond interest paid is face value times the face rate. Okay, so let's go on. Okay, I highlighted the one we're on. At this rate, we're never going to get done here. But Evermaster Corporation issued $100,000 of 8% term bonds due January 1st with interest payable July 1st and January 1st. Investors require an effective interest rate of 10%. So notice the bonds are paying 8, the market rate is 10, so they should be selling at a discount. Okay, and before they would tell us, notice this is what we're going to sell them for, but I'll get through there in just a second. They would be selling at around 92. So in the other one, they would say 92, and then we'd use cash of 92,000. But the exact amount is 92,278. Okay, so what I do is I use the present value tables. So I'm going to draw it out. Bear with me. So the cash flows are, they're going to pay back $100,000 at the end of, on January 1st, 2012. So, and they're going to pay $100,000 times 8%, but I'm paying on July and January. So I'm going to pay 100,000 times 8 is $8,000. Every times a half a year is $4,000. So I'm going to pay $4,000 every 6 months. So if you look at this, I need to bring this back to the present value, and I need to bring these back as the present value of an annuity. And then I'm going to add those up and get the difference, or the total amount. So this one, notice it's present value of $100,000 due in 5 years at 10% interest. Okay, because I want it to be the market rate of interest. And so notice, let me hold on a second. Should be 5 years. Okay, 2017 to 2020 is 5 years, and then this is 10%. Okay. Okay. So since it's payable semi-annually, I change that to 10 periods, and semi-annually is 5%. Okay, with them being the same number, it's a little bit confusing. So notice I've got present value of 10 periods, 5%. 10 periods, 5%. And that factor is 0.61931, so I take $100,000 times 0.61 or 931 and get 61,000. And then I take the present value of these for 10 periods, 5%. The only time you use this 8%, guys, is to figure out the $4,000. Then I can do this to it, cross it off. I'm never going to use that again. So I would just do $100,000, then I would say it is semi-annual interest, so I'd do $4,000 of interest. And then I would cross that off. So I would only use the $100,000 and the $4,000. I'm forcing them to earn 5%. So right here, I'd change that to 5, and I wish it said 5 periods there instead of having to count the dates. And then I'd cross out the 5 and change it to 10. So I do the present value of the $4,000 times present value of annuity factor, 10 period, 5%. Then that's the factor. You look them up on your tables. I add them together, and I get $92,278. Okay? I only do these two. I don't do this part of it. You're going to see why in a second. Bonds payable is always credited for, pause it here, just showing that they go 10 periods, 5%, 10 periods, 5% for the annuity, 10 periods, 5% for lump sum, 10 periods, 5% of annuity. Okay? I want to go to the interest, or the entry, then I would come back to this. Okay, so go look at your amount you put up here, and the entry is credit bonds payable for the $100,000, always face, debit cash for the $92,278. I need a debit to balance, that debit's a discount. Okay, then I'm going to do this schedule of bond amortization, and actually, hold on. Okay. Look at my little Excel spreadsheet here. I'm going to show you how you can do these really quick. So notice that I've got my bonds payable. So that's my bonds payable account. My discount account is 7722. And so the carrying value is always the bond minus the discount, which on day one is always the same as cash. Okay, right there. Because this is technically the carrying value of my bond, the bond minus my discount. Okay, so however, the cash I pay is always face value. So the face value is my bond is $100,000. And my face rate is 8%. That's what's stated on the bond. So notice it says semi-annual interest payments, 5 years, 8%. Okay, now, and then I have times 1/2 a year. Okay, so that is going to be $4,000. Notice if I've crossed out this $8,000, right here on previously, and I put 4% and crossed off that to read 5%, I could use my 4 and 5% instead of taking $10,000 times 1/2. So let's just actually do that. So I've got my face value times my face rate, which is 4%. Okay, my interest expense is always my carrying value times the market rate, which is 5%. So my interest expense is that. And so my discount is going to be simply interest expense minus cash. Okay, so if I look at my journal entry, my next journal entry, let's go over here. I'm going to debit interest expense. So again, debit interest expense, credit cash. Okay, the difference between this one and last one, what I did is I knew my cash was always the $4,000. And what I told you before is then you plugged in the discount, or you put in the discount, which was under the straight line method. It would have been this divided by, in this case, it's 10 periods. So I just do this divided by 10. So that would be 772 under the straight line method. And then I plug interest expense for the difference. Here I tend to do cash, then interest expense, and plug the discount. Okay, so notice, I'm going to make that less just a second. Never mind, this is just, that's showing a decimal point, so it's 614 there. So just ignore the 0.1% because I can't change it quickly. Okay, so notice I've got my cash, my interest expense, or carrying value times market rate, and the discount is just basically the plug. So then what happens is my discount is going down, because if I look at this previous slide here, someplace, I have my my discount is debited and now I've credited it. So my discount is going down, so it's 7722 minus how much discount I amortized. So now my bond is still $100,000, okay? And my carrying value of the bond is my $100,000 minus 7108. So notice my carrying value is going up. My carrying value is always going to go towards face. So if I took the 92.78 and I took that plus my discount, how much discount I amortized, I'm always climbing towards face by the amount of discount amortized. Okay, so now let's go to the next period. Cash is always going to be the same, I think, for 10 periods. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, so I can ditch these. Okay. My interest expense is always my carrying value times the market rate, which is 0.5. Okay, typed in the right number this time. So it's that times 5%, 46.45. So then I'm going to amortize my discount, which is the difference between those two. So 645. Again, my discount, I keep getting rid of my discount or premium, so that minus 645. And now my carrying value is 100,000 minus the 645. And notice it's getting closer to face. And so if I would take this minus that, it's getting closer to face by the 645. Okay? So now what I'm going to do is do maybe one more line, then I'm just going to copy them down. So I know my cash is always credited for 4,000, so I don't know if this one. So notice the next entry is, again, only because it's not cash, because they pay it on January 1st instead of December 31st. Cash is 4,000. Interest expense is 46.45, and my discount is 6.45. I'm going to go and pull that on down, which didn't work, so I've had to do all my cells at once. Okay, so notice what happens is I have always cash is 4,000. My interest expense is always the carrying value times 5%. So if I look at these, look up here, right here, in this one. Whoops. 5% is that times 5%. Then I'm going to go down to here. That times 5%. Then I'm going to go down to the next one. H7 times 5%. H8 times 5%. H9 times 5%, etc. So the prior carrying amount times 9%. The discount is always the 4,000 minus that. Notice my discount is being amortized. And so my discount is always going towards 0, and my bond face value and face interest are always going to stay the same, and my carrying value moves toward $100,000. So at the end, My amortization table, my carrying value at the end of the 5 years or 10 periods is always $100,000. So you should be able to record the interest payment. So my interest payment for the first one is credit cash for $4,000, debit interest expense for $46.14. Discount is plug the difference. And for the next one, it is interest payable for $4,000, interest expense $46.45, and my discount is $6.45. Notice this you might do cash too. Again, it's just because it's December 31st. Okay, so now we're going to go on to the next one and see if they're issued a premium, which should go pretty quick here. Okay, so now same thing, $100,000, 8%. So the first thing I'm going to do is cross that off, and since they pay it semi-annually, so I'm going to cross this one off, and I've got 4%. Actually, I'm not even going to do that. $100,000 times 4% is $4,000. So I never use that 8% again. And then it says effective interest rate of 6%, but since it's semi-annually, I'm going to write 3% there. So I'm going to use face value, $100,000. Face rate is 4%, but I really don't need that. I'm just not even going to write that. Face amount that I'm paying is $4,000. Effective interest rate is 3%. So I go back to the present value tables. I can draw this out again. Same thing. I'm getting my $100,000 at the end. And I'm also getting $4,000 each period. That's $4,000 each period for the next 10 periods, 5 years. But now I'm going to bring it back times the annuity. And I'm going to bring that back to today. Add them up. So a present value of lump sum of this, present value annuity of that. But I'm going to bring them back to earn 3%, whereas in the prior problem, I brought them back to earn 5%. So notice before, the 5% was above the 4% face. Now it's below the 4%, or below the 4% face. Okay, so present value, 10 periods, 3%, 10 periods. It was 5 here, so since it's semi-annual, I put 10 periods. 10 periods, 3%. Always market. Always changing them to earn market. So 10 periods, 3%. That factor is 74409. And look at your present value of annuity table. 4,000 times 10 periods, 3% on annuity is that factor. I add them together. I get cash of that. So that's my bonds payable. That's my cash. Let's go make your entry. Next slide. Oh, that's the present value. You can look through that yourself. Okay, so now I credit bonds payable for face, I debit cash for 108,533, and now I have my present value. So I'm going to pause here. So notice that I have in this thing, this is the one I had before, but let's go change this to, instead of 5%, it's going to earn 3%, okay? And now I'm going to drag it down. Okay, so now this is going to be a negative sign simply because in my other ones, my interest expense was more than 4,000, but it's not going to change the entry. So let's go over here and look at the entry here. So notice I have interest expense and cash, debit interest expense, credit cash. Cash is always going to be the $4,000 right here in every one of them. And now, what did I do wrong? What did I pause? Okay, it would be helpful if I actually made it a premium. So I've got 8530. And so my carrying value is now my bond plus my premium. Okay. So let me fix this to get these going the right direction. Let me do that. Okay, 3, 2, 5, 6, and 3. Okay, I got it. I think. Okay, I had to change my signs on that because it was messing up all my formulas in there. Now I've got to stop again. All right. So I have my cash is 4,000. My interest expense is always my carrying value times 3%. My premium amortized, that's not a discount, that's a premium. My premium amortized is the difference between those two. That's my amortization. So notice this is my journal entry. So I've got the bonds payable for 100,000. I've got my carrying values, my premium plus my bond. So carrying value, a premium is it's selling above. That's why all my formulas, I had a discount, so I was subtracting them. And then, and my interest expense one, my cash is 4,000 right there. My interest expense is 32.56. My difference is my premium. My premium, again, my discount or premium is going to disappear. Always got rid of, and I'm amortizing it. So if I go back here, notice I credited premium on the, if you look at your page there, on the prior one, you debited discount. So when I'm getting rid of my premium, I'm debiting it. When you got rid of your discount, you're crediting it. So your premium or discount is always going away. And notice my carrying value is always moving towards face. So in the discount, this carrying value was lower and it was increasing to face. This one, the carrying value is higher and it's decreasing to face. Because basically these two are added and I'm always adding a smaller and smaller number. So journal entry, cash, interest expense, premium or discount. In this case, it's a premium. Next one, oops. You can do your next payment, which will be cash, interest expense, premium, cash, interest expense, premium, etc., etc. And notice the carrying value, 105,418, 105,417. So I'm rounding off. Okay? Okay, so the next one we'll write down here, what happens if Evermaster prepares financial statements SAT the end, apparently I can't type, at the end of February 2017, and just basically they would prorate the interest. So notice I have at the end of February, so the last time I paid interest was December, so then I have January and February. So I just simply do 2/6 of the interest and 2/6 of the premium. And then your journal entry is interest payable of 2/6 of every number that you would have on there. It's as simple as that. So just quickly, discount or premium, they go on the financial statements right after bonds payable, and you either subtract the discount or add the premium. So again, just like accumulated depreciation, you always show them together. Okay, so now we're going to switch to extinguishing debt, which is calling off, but I am kind of running out of time here, and I'm kind of tired after 52 minutes, so I'm going to pause here and make a separate video starting on number 8.